Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. And in this video, I want to talk to you about the 4 types of private mortgage insurance. Private mortgage insurance has to do with the cost of home ownership, and it's a sneaky little cost that you might not know about if your lender or realtor doesn't explain it to you. Private mortgage insurance, also known as PMI, is typically on a conventional loan, and it's when you put less than 20% down payment when purchasing the home. Private mortgage insurance actually protects the lender in the event that you don't pay. It doesn't protect you at all. It's arranged by your lender and funded by a private mortgage insurance company. In other words, when you put less than 20% down on a conventional loan, you can expect this sneaky little cost, and it doesn't even protect you at all. It protects your lender. Now, PMI can actually come in 4 different forms, which is what I'll be discussing with you in this video. The first is borrower-paid mortgage insurance. This is your most common type. This is when the cost of the PMI is embedded within your loan into each monthly payment. Typically, once you reach a 22% equity within your home, you can cancel the PMI. Through regular monthly mortgage payments, this can take almost 15 years. With recent economic changes in the housing industry and prices of homes going up, it might have changed, but on average, you can typically expect to get 22% equity in your home over the span of 15 years. So this form of PMI, borrower-paid mortgage insurance, might be the best type for someone who isn't exactly sure how long they will be in the home. The second is lender-paid mortgage insurance. So this is when your lender pays for the mortgage insurance. However, this doesn't mean you get free and clear out of the cost. You see, the way that you end up paying for this private mortgage insurance is through a higher interest rate. Since the lender is paying for the mortgage interest, they are essentially passing down the cost by offering you a higher interest rate. The reason why this isn't a favorable PMI form is because it's not cancelable after you reach 22% equity. It stays the entire time you have the loan. The reason why it exists, or the benefit, might be that your payment monthly might actually still be lower than the first form of PMI I discussed, even with a higher interest rate. The third form is single premium PMI. You might not have heard of this because not all lenders offer this option. Basically, with this option, you pay for your PMI all at once in one single payment at closing. It's not necessarily a lucrative form to do this because if you leave the home for whatever reason, sell the home, get out of the mortgage within a certain amount of time, that single payment is not refundable. However, if you do plan to stay in the home for at least 3 or more years, it might actually be lucrative to you because it's a one-time cash payment, your monthly payment is still low, and you got to put less money into the home when you first bought it. The fourth and final form of PMI that I'll be discussing in this video is called split premium PMI. This is the least common type of PMI, and it's basically a hybrid of the borrower mortgage private insurance and the single premium private insurance. It's basically when you pay a portion of your PMI at closing and another portion through monthly payments. So your closing costs aren't that high, and your monthly payment also doesn't go that high. You basically split the responsibility between the 2 events. Remember that in the end, you can avoid private mortgage insurance altogether if you have 20% or more as a down payment for your future home. We hope this video helps you on your journey to home ownership. To keep up to date with all the information we're putting out, hit the like button, subscribe to our YouTube channel, follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.